The bill that was signed into law in late December of 2010 had numerous provisions in it that are beneficial to taxpayers in general, but I think two of particular interest to farmers and agricultural landowners and maybe rural businesses, agribusinesses in particular. And those are the bonus depreciation provision and the expense method depreciation provision. Both of those provisions have been accelerated in the instance of expense method depreciation up to $500,000 of qualified purchases during the year, and that includes a lot of tangible personal property that a farmer would acquire and use in their business during a particular year, with the limit, the phase-out limit, not even starting until you get to $2 million worth of purchases of qualified property in a tax year. Very few people ever hit that limit. So that's an off-the-top depreciation allowance of $500,000 for the tax year, and that's huge, and that will run through 2011. So that's for 2010 and 2011. It's retroactive back to the beginning of this year, extended through 2011. Now that's at the federal level. The state of Iowa and many other states do not couple with the federal government on that provision, so you'll have a different tax filing result at the state level, but that's a major provision at the federal level. Bonus depreciation was reinstated in a different bill earlier this year, but this bill, signed in late December, moves it to 100% bonus depreciation for qualified assets placed in service after September 8 of 2010 through next year. And again, that is a very, very big deal for many farmers and ranchers in terms of purchases of big assets. And it's designed to try to stimulate equipment purchases, other farm asset type purchases. The assets that qualify for the bonus provision have to be new, Section 179 expense method depreciation. They can be used assets, but they need to be used in the taxpayer's trade or business. Farm buildings that wouldn't qualify under Section 179, such as a machine shed, will qualify under the bonus provision. And taxpayers just need to seek their tax counsel to try to sort out what might be the best move for their individual situation. When we get this late in the game and when it actually comes time to file the return, a lot of the tax planning is done. There's not much you can do at this point in time. There are only a couple of things that remain possible to do in early 2011 that can have an effect on the 2010 tax return. Some of those involve additional contributions to certain types of retirement accounts, to health savings accounts, those types of things. But now we're into the domain of starting to plan for 2011 tax filing season, which will be this time next year. And so what you do in 2011 will influence how the return is prepared for you for the 2011 year. But the standard moves that farmers will have to consider in terms of whether to defer payments on grain contracts, for example, enter into forward grain contracts, how they manage risk in their business in conjunction with the various tax provisions that are available to them and tax moves that they can make as part of their overall risk management strategy. Those are the moves that now, while they don't have a crop in the field yet and are not out in the field yet, it's a good time to consider those things at this time of year.